if you're thinking about looking for a big pullback to buy silver, think again. The opportunity to buy $50 silver is long gone. You're lucky if you could buy $70 silver, but I wouldn't even wait for that. I think the supplies of silver are going to start to run low and the premiums are going to really start to blow out. At one point, gold was up better than $120. Silver was up over $6. Wall Street is starting to figure out that gold and silver aren't going to crash. These sell-offs are irrelevant. Gold could go to $3,000 and they'd still be cheap. So what difference does it make if it's $4,600 or $4,500 or $4,300? Gold and silver stocks have tripled along with the price of gold and silver, but their profits are going to go up a lot more than triple. Everything that Donald Trump is doing is pushing the world away from the dollar and into gold. Weekend gold rally, and that was the announcement from Jerome Powell. The reason that Ben Bernanke said new record highs for both gold and silver. In fact, the records were set on Monday. We had a huge rally starting Sunday night into Monday. At one point, gold was up better than $120. Silver was up over $6. It was the biggest dollar rally in one day I've ever seen in gold. Now, percentage-wise, it wasn't a record, but dollar-wise, it was. Gold rose to a high of about 4,640, and silver was trading above $93 an ounce. We ended up closing the week for gold at just below 4,600. I think we went out about 4,594, 95. Silver managed to close the week, I believe, just above $90. Now, we went out on a down note. Both gold and silver had sharp sell-offs intraday. Silver was down over $4 at one point during the day. Gold was down about $70 on the lows. But by the time they wrapped up trading for the week, gold was only down about $20 and silver was down about $2.25. Now, silver's been a lot more volatile than gold all week. But the important point is that the volatility is taking place at these very high prices. And this is just another consolidation of this big breakout.
Record highs followed by sharp intraday sell-offs aren't weakness, they're stress tests at elevated levels. What matters here isn't the pullback, it's where the volatility is occurring. Near historic highs, not near support. As Peter Schiff has repeatedly pointed out, large dollar moves at these price levels signal institutional repositioning, not retail panic. A $120 daily move in gold and a $6 swing in silver reflect liquidity chasing protection, not speculation unwinding. Historically, post-breakout consolidations at highs often precede continuation, especially when silver holds above prior resistance near $80. For investors, this shifts the risk from timing pullbacks to managing exposure size and volatility tolerance. And next, Peter Schiff explains why waiting for a perfect entry may already be the real risk.
So if you're thinking about looking for a big pullback to buy silver, think again. The opportunity to buy $50 silver is long gone. Right? And you're lucky if you could buy $70 silver, but I wouldn't even wait for that because I think the supplies of silver are going to start to run low and the premiums are going to really start to blow out so that even if silver goes down, the price of silver coins and bars may still go up. And in fact, most of the move on the week, this week, happened on Monday. Right? So you caught the whole thing just buying over the weekend, which is what I urged all the listeners or viewers to the Market Wrap to do when I recorded a week ago. And I'm going to give out the same advice now. And that is, don't wait for Monday. In fact, this Monday is Martin Luther King Day. So if you're going to wait for regular trading to resume, You're waiting for Tuesday. Don't wait. I think we're going to have another huge move up on Sunday night, Monday, Tuesday. So to beat the herd or the crowd, I recommend that as soon as you are finished listening to this market wrap, you go right to Schiff Gold and buy more gold and silver.
The real cost of waiting isn't price, it's availability. This part highlights a critical disconnect between paper prices and physical reality. As Peter Schiff emphasizes, silver's market isn't just a chart, it's a supply chain where premiums expand even during price dips. In past cycles like 2010 to 2011, physical premiums surged weeks before futures peaked. The implication for investors is practical. Exposure timing matters less than form and access. Holiday closures, thin liquidity, and weekend gaps amplify risk for those trying to outsmart momentum rather than position early. Peter Schiff's next point shows why mining stocks haven't caught up and why that matters for portfolios.
And even better, if you are not yet a shareholder of my gold fund, the Euro-Pacific Gold Fund, EPGIX, I would suggest that you buy that too. Now, again, gold stocks are different types of investments than physical precious metals. There's a lot more inherent risk when you own an operating business that is generating a profit. I look at gold and silver as a store of value, long-term, safe haven. Gold and silver mining companies are risky businesses, right? I mean, there's so many things that can go wrong when you're operating a gold mine. But the upside potential dwarfs the downside risk. And in fact, I think today was a great day for the gold mining stocks because when gold was down about $70 and silver was down $4, these stocks were all getting killed this morning, down 3, 4, 5%. Some of them, I saw one silver stock that I own was down about 8%. Now, it ended up positive on the day. But why are these silver stocks getting hit so hard when silver is $90 an ounce? None of this makes sense. Yes, gold and silver stocks have tripled along with the price of gold and silver, but their profits are going to go up a lot more than triple. These stocks should be much, much higher.
When miners fall on metal dips, it reveals confusion, not fundamentals. The sell-off in miners despite $90 silver exposes Wall Street's shallow modeling. As Peter Schiff has argued, earnings leverage in mining stocks expands non-linearly once fixed costs are covered. A 3x metal price move can translate into 5 to 7x cash flow expansion, yet analyst models still anchor to outdated price decks. Intraday drops followed by reversals suggest forced selling, not valuation resets. For investors, this highlights opportunity, but also volatility, inequity exposure versus physical metals. Peter Schiff then explains why Wall Street still refuses to price this reality in.
The reason they're not is because Wall Street still doesn't understand what's going on. And remember, there are really two different buyers. Wall Street, where they buy stocks, they're not buying the physical metals. They're looking at stocks. And they don't understand why gold and silver are going up. And they don't expect the prices to keep going up. In fact, they don't expect the prices to stay up. That's why they've been so reluctant to bid up mining stocks and adjust their future earnings forecasts for higher gold and silver prices. In fact, they're still assuming that gold prices in the future are a lot closer to where they were in the past than where they are right now. Now, indication that maybe that's changing was the action today, because even though gold and silver finished down on the day, most of the stocks recovered all those morning losses and finished positive on the day. They all didn't finish positive, but many of the stocks that I own not only finished positive on the day, but made new multi-year highs on the day, despite gold and silver being down. And what I've been saying is that these sell-offs are irrelevant to the value of these gold mining companies. Gold could go to 3,000 and they'd still be cheap. So what difference does it make if it's 4,600 or 4,500 or 4,300? Doesn't make any difference at all.
Wall Street's models are anchored in the past, and that's the real mispricing. This is a textbook case of backward-looking valuation. As Peter Schiff notes, analysts still forecast gold closer to old ranges, not current regimes. That's why miners recover even on down metal days. Smart money sees earnings durability, not spot noise. Multi-year highs during metal pullbacks signal rotation, not speculation. For long-term investors, this suggests miners are being repriced slowly, not irrationally ignored, creating a staggered entry window rather than a single breakout moment. Next, Peter Schiff connects this mispricing to a much larger warning signal forming beneath the surface.
Gold stocks should be going up every day at this point, regardless of the short-term fluctuation in the price of gold that has no bearing on what these companies are going to earn now or in the future, and probably even more so with these silver miners, given how much the price of silver has gone up. And again, as I mentioned on my last report, very few people seem to understand that gold companies also mine silver. It just reduces the cost of their gold. And now their costs are going to collapse because the silver byproduct that they're mining when they're looking for gold is now so valuable that it is dramatically reducing the cost of mining gold. But I think the action I saw today is a little bit constructive in that maybe, just maybe, Wall Street is starting to figure out that gold and silver aren't going to crash. And eventually they're going to realize that they're going to keep going up. And they're going to keep going up because of the fundamentals. And the fundamentals are getting better and better for gold and silver with each passing week. So what I would do, again, to buy my gold fund, you can go to the Euro-Pacific website, europac.com, check it out, read the prospectus.
The real story here isn't gold prices. It's collapsing costs Wall Street hasn't modeled yet. As Peter Schiff points out here, miners don't need higher spot prices to grow earnings when byproduct silver is slashing all-in sustaining costs. Many gold miners generate 10 to 25% of revenue from silver, meaning margin expansion accelerates even if gold stalls. Yet analyst forward guidance still assumes flat cost structures, a clear valuation gap. For investors, this disconnect explains why miner sell-offs don't align with fundamentals and why earnings revisions tend to lag price reality. Next, Peter Schiff explains why timing mechanics, not fundamentals, can still surprise investors.
Unfortunately, if you want to invest in that fund, you've got to wait until Tuesday because the markets are closed. In fact, mutual funds you can only buy on the close. So I have a feeling that the fund will be up a lot on Tuesday because I expect a big move in gold and silver over the 3-day weekend and an even bigger move in the mining stocks.
Market closures don't pause risk. They concentrate it. As Peter Schiff has warned in similar setups, long weekends compress volatility rather than eliminate it. Thin holiday liquidity often leads to sharp gap moves, especially when metals trade globally, while US funds sit frozen. Investors relying on open market access risk, chasing higher prices after the fact. This isn't about prediction. It's about understanding market structure and timing exposure before price discovery resumes. Peter Schiff then shifts from timing risk to a deeper macro blind spot Wall Street keeps missing.
Obviously, the gold and silver market, when Wall Street is focusing on these backward-looking CPI numbers, they're ignoring the forward-looking action in gold and silver. And again, it makes me laugh when I watch, Wall Street, trying to figure out why gold and silver prices are going up. And their explanations are almost as funny because they don't get it. Because if they understood why gold was going up, it destroys their entire thesis. That's the basis of their recommendation of the overall stock market and the U.S. economy is great. It's not great. If the U.S. economy was so great, gold would not be $4,600 an ounce, right? Silver would not be $90 an ounce if we had a strong economy, right? We wouldn't be running these massive deficits if we had a strong economy. You know, people were making a big deal about the trade deficit, finally took a big drop, and they want to credit Donald Trump for this big drop in the trade deficit and say, hey, you know, maybe it's the tariffs. It's not. The main reason that the trade deficit went down last month is because a boom in gold exports. We exported a lot of gold, right? We didn't manufacture that, right? That's our gold that got exported, and that's 90% of the improvement in the trade deficit for the month was all the gold that left the country. That's not a good sign.
When gold exports fix the trade deficit, the economy isn't healing, it's liquidating. Peter Schiff exposes the flaw in headline optimism. CPI looks backward while gold prices discount future stress. A $4,600 gold price alongside record deficits contradicts the strong economy narrative. Exporting domestic gold to improve trade numbers is a balance sheet illusion, not growth. For investors, this signals capital preservation behavior at a national level. Historically, a late cycle warning sign, not a bullish green light. Peter Schiff's next point shows how this imbalance shifts global power away from the dollar.
You know, our imports were down, but our exports weren't really up that much. And the main reason our imports were down is because they're more expensive, so we can't afford to buy them. In fact, if you look at China's numbers, China's exports to the U.S. were down, I think, 20 or 30%. Yet they posted all-time record high trade surplus. How is that? They're selling less to America, but more to the whole world, right? So what they didn't sell to us, they sold to the Europeans. They sold to the South Americans. They sold to other Asian consumers. So our loss was their gain. Other consumers got what we could no longer afford. And China didn't miss a beat. In fact, the Chinese yuan was up about 5% last year, closed the year, 2.5-year high, and it's already rising again. And so China is winning the trade war. They're going to win the currency war. The RMB, the Chinese currency, is going to rise substantially against the dollar. And that's a good thing for the Chinese. That means the Chinese are going to be wealthier. They're going to have higher standard of living. You know, we keep talking about the affordability crisis. The cost of living is going up. Well, it's going to get a lot higher, right?
Trade wars don't disappear. They just change winners. As Peter Schiff highlights, falling US imports signal reduced purchasing power, not improved balance. China's record trade surplus, despite lower US exports, shows demand is global, not dependent on America. A 5% win rise while the dollar weakens flips the affordability equation, pressuring US consumers and boosting foreign living standards. For investors, this points to currency-driven inflation risk and long-term pressure on dollar-denominated assets. Peter Schiff next connects this currency shift to why gold keeps sending warnings markets ignore.
Things are going to become a lot less affordable in the United States as the dollars that Americans earn are less valuable. As the purchasing power of the dollar goes down, affordability or unaffordability goes up. It's going to be harder to afford things when the currency doesn't buy as much. But the opposite's going to be taking place in China, right? Things are going to get a lot more affordable for the Chinese. Prices for them are going to get cheaper because their money is going to become more valuable. But of course, if you own gold and silver, if that's the money you save, then everything is going to be cheaper. The price of everything that you need to buy will be less expensive if you have gold and silver to pay for it. I mean, that's one of the reasons that I'm setting up T-Gold because I want to enable people to have a currency, have money that will buy more over time, not less, right? You don't want your savings to erode in value before you have a chance to spend it. You'd like your savings to grow in value so that when you go to buy something, you could actually buy more than when you set the money aside. That's how money is supposed to work. The longer you wait to spend it, the more you're supposed to get, right? That's capitalism. That's how it works. It's socialism. It's central banking that has perverted sound money and given us constant inflation.
The quiet crisis isn't prices rising. It's wages and savings silently shrinking in real terms. As Peter Schiff points out here, a weakening currency flips affordability against consumers even if paychecks rise nominally. The dollar has lost over 96% of its purchasing power since 1913, which explains why everyday costs feel unmanageable despite strong employment data. Gold and silver don't create wealth. They preserve it when policy erodes money's function as savings. For long-term investors, this reframes metals not as speculation, but as insurance against policy-driven decay. Peter Schiff then explains why this erosion accelerates when trust in institutions cracks.
Weekend gold rally, and that was the announcement from Jerome Powell that he received a notice from the Justice Department that he is under criminal investigation for statements that he made to Congress about the renovation project of the Federal Reserve building in Washington. So I spoke at length about that, as well as the president's harebrained idea to cap credit card interest rates at 10%, and how this stuff, also the stuff that he's saying about Greenland. I mean, everything that Donald Trump is doing is pushing the world away from the dollar and into gold. I mean, he's not doing it intentionally, but the unintended consequence of the policies that he's pursuing are very bullish for gold and silver. Now, they're bearish for the dollar. The dollar hasn't cracked yet. The Treasury bond market hasn't cracked yet. That is coming, right? Gold and silver are the early warning. To me, it's just like 2007 when subprime blew up. That was the warning that the rest of the mortgage market and the financial system was going to follow. I knew the financial crisis I had been forecasting for years was a lot closer to a reality once I saw what happened to subprime.
Gold didn't rally on emotion. It reacted to institutional credibility risk. As Peter Schiff notes, markets price trust faster than headlines, and a Fed under investigation undermines confidence in policy signaling. Political interference, price controls, and erratic policy ideas historically weaken reserve currencies, not strengthen them. The dollar and treasuries often lag the warning, just as subprime did in 2007 before the broader collapse followed. Investors ignoring metals here may be dismissing the same early signal they missed last cycle. Peter Schiff's next point draws a direct line from denial to delayed disaster.
But the reason that Wall Street was oblivious, the reason that Ben Bernanke said subprime is contained, is because he didn't understand the problem in the economy, in the housing market, in the mortgage market. So from their perspective, it was no big deal what happened to subprime. I knew it was the tip of a huge iceberg. And I appreciated the warning because I understood what the warning was about. Same thing is happening now, right? The financial crisis didn't come until a year later. Subprime blew up in 2007. Financial crisis happened later in 2008. And in fact, in early 2008, people still thought everything was great, right? Even though we were already in the Great Recession. They didn't know about it yet. I knew about it, but they didn't find out until the end of the year when they revised all of the economic data going back a year and said, oh, by the way, we've been in this Great Recession for a year. Well, what happened with gold, what's happening now, I think, is forecasting a much bigger monetary crisis that may hit later in the year or maybe even next year, but in the dollar, in the bond market.
The most dangerous phase of a crisis is when data revisions haven't caught up to reality. As Peter Schiff emphasizes, policymakers misread subprime because they focused on surface metrics instead of system leverage. Recessions are often acknowledged months late, after portfolios already absorbed the damage. Gold tends to front-run these revisions because it trades on confidence, not reported GDP. Investors relying solely on official data risk reacting after markets, not before them. Peter Schiff then outlines why this time the stress point is even larger.
So gold is reacting first, just like subprime reacted first in 2007. You saw the broader crisis hit a year later. Same thing's going to happen now, except it's not a mortgage credit that is the problem. It is government credit. It is sovereign debt. It is the debt of the United States. It's not a mortgage crisis. It's a U.S. Treasury crisis. That's what's coming, and a U.S. dollar crisis. Gold and silver are your early warning signs. First it was gold, and now it's silver, and of course platinum. The whole precious metals complex is flashing that the dollar is in trouble, that the U.S. bond market is in trouble. And what Trump is doing is playing a big role in that. But we also have some news that came out this week that I didn't have on Monday when I did my main podcast. So I want to get into this news that is also bullish for gold, and that is inflation and the inflation numbers. So we got the official CPI numbers came out on Tuesday, and the media initially hyped this up as if it was good news. Like, oh, see, inflation is going away, right? But here are the actual numbers.
This isn't a housing warning. It's a sovereign balance sheet warning. As Peter Schiff argues, when government credit becomes the risk, the safety net disappears. US debt now exceeds $34 trillion, and rising yields magnify rollover risk the way adjustable mortgages once did. Precious metals signaling stress across gold, silver, and platinum suggest systemic pressure, not a niche trade. Investors anchored to treasuries as risk-free may be holding the epicenter instead. Peter Schiff next dissects the inflation data Wall Street spun as good news.
So the PPI, and these are December numbers. So the month increase in consumer prices was 0.3. The prior month was 0.2. So it got worse. And if you annualize 0.3, you're looking like 4% inflation. That's double the Fed's 2% target. The Fed is cutting rates. They're talking about rate cuts, and inflation is twice what they claim they want it to be. They should be hiking rates, not cutting rates. And how is this good? Then the year-over-year increase in the CPI, which was forecast to be 2.6, came out at 2.7. So it's worse. It's worse than they thought, right? Yet they're still talking about rate cuts. Right? Now, I guess where they got the improvement, right? And this is, talk about making a lemonade out of lemons.
The inflation victory lap collapses when you do basic math. As Peter Schiff points out, a 0.3% monthly CPI pace annualizes near 4%, not 2%. Rate cuts alongside rising inflation signal policy trap between debt servicing and price stability. Markets cheering cuts may be celebrating short-term liquidity while ignoring long-term currency damage. For investors, this raises the risk premium on bonds and cash simultaneously.